New $6,000 senior tax deduction? What it means for you. Well, there's a lot of talk about a massive new tax package that has cast the Senate. You're hearing headlines about a new $6,000 senior tax deduction, and some are calling it the most significant tax change for retirees in years. It's being sold as a fulfillment of campaign promises to help those 65 and older by slashing the tax on your retirement income. But what does a $6,000 deduction actually mean for you? Is this real money back in your pocket or just political noise? This is The Wealthy Elder, and in this video, I'm going to break down exactly what this bill means for your retirement savings. We're going to cut through the jargon and look at the real numbers with clear examples so you know what to expect. Let's build wealth. Section 1. The problem: the overlooked tax burden in retirement. Now, before we get into the details of the bill, let's talk about the problem it's trying to solve. For years, retirees have had to watch their hard-earned savings get taxed. You spend your whole life saving and contributing, only to find that in retirement, Uncle Sam still wants a big piece of your income. The biggest issue for so many seniors is the tax on Social Security. Keep in mind, Social Security is not fully taxed already. The maximum that can be taxed is 85% of your benefit. But this still creates constant financial anxiety and forces many to worry about outliving their savings. To me, it makes no sense that after a lifetime of work, you have to keep stressing about federal taxes eating into your nest egg. This proposed deduction is the latest attempt to fix that, but as we'll see, the solution isn't as simple as it sounds. Section 2. The proposed solution: breaking down the $6,000 deduction. So, what exactly is on the table here? The Senate has passed a version of a tax bill that includes a new deduction specifically for seniors. The main feature is a $6,000 deduction for every individual age 65 and older. And if you're married and both you and your spouse are over 65, that's a potential $12,000 deduction. Now, it's critically important to understand this is a deduction, not a credit. A credit reduces your tax bill dollar for dollar. A deduction just reduces your taxable income. So a $6,000 deduction means you subtract $6,000 from your income before you calculate the tax you owe. The actual savings depends on your tax bracket. For someone in the 22% tax bracket, a $6,000 deduction means about $1,320 in tax savings. For a couple getting the full $12,000, that's over $2,600 back in their pocket. Keep in mind, this new deduction is temporary. The current proposal has it in effect for the 2025 through 2028 tax years. After that, it would expire unless Congress extends it. There's also still a debate going on. The House passed a version with the $4,000 deduction, while the Senate went higher at $6,000. It's still unclear which number will be in the final bill, but the momentum is there. Section 3. How it works, who qualifies, and how it stacks up. Now, I'm going to go over how these deductions work and who actually qualifies. It's based on two things: age and income. First, age. You have to be 65 or older by the end of the tax year. This doesn't apply if you retire early at 62 or 63. This is strictly for those 65 and older. Second is your income, and this is where it gets complicated. The full $6,000 deduction is available for single filers with the modified adjusted gross income up to $75,000, and for married couples filing jointly with the MAGI up to $150,000. If your income is over those limits, the deduction starts to phase out. For every $100 you earn over that threshold, the deduction gets reduced. It's designed to gradually disappear, and it's completely gone for single filers earning over $175,000 and married couples over $250,000. This is really targeted at low and middle income seniors, not the wealthiest retirees. So let's go through an example now of how this stacks up. This new deduction is in addition to all the deductions you can already claim. Let's take a married couple, both age 70, with a combined income of $100,000 in 2025. Here's how their deductions would look under this Senate plan. Standard deduction. For 2025, this is projected to be around $30,900 for a married couple. Existing age-based deduction. Because they are both over 65, they already get an additional amount. This is projected to be around $1,600 per person, so that's another $3,200. New senior bonus deduction. Under this new bill, they would get another $6,000 each for a total of $12,000. You add that all up, and $30,900 plus $3,200 plus $12,000 comes out to a massive $46,100 in total deductions. Their $100,000 income is now reduced to a taxable income of just $53,900. And one of the best parts is that even seniors who itemize can still claim this new bonus deduction. Section 4, the impact, the real-world winners and losers. So while this sounds great, the real-world impact is a little more nuanced. The benefits are not spread out equally. The biggest winners are middle-income to upper-middle-income seniors. These are people who have a tax liability but aren't earning so much that the deduction phases out. A married couple earning $100,000 a year could see savings of around $1,600 annually. For many, this could effectively cancel out the federal tax on their Social Security benefits. The White House is even claiming that with this change, 88% of seniors on Social Security would pay no income tax on their benefits. But there are two groups who get very little from this. First, low-income seniors. Millions of seniors already have income so low that after the standard deduction, they pay zero federal income tax. An extra deduction is meaningless if you don't have a tax liability to begin with. Second, high-income seniors. As I said, the deduction disappears for individuals over $175,000 and couples over $250,000. If that's you, this particular tax break isn't for you. There's also a bigger economic issue here. Some budget groups have warned that this tax cut could speed up the depletion of the Social Security Trust Fund. The Committee for a Responsible Federal Budget estimates it could move the trust fund's exhaustion date up by a year, from 2033 to 2032. At the end of the day, while it's pitched as a universal benefit, it's really a targeted cut for a specific demographic. Section 5. Actionable advice. What should you be doing now? With this moving forward, what should you be doing right now? First, know your number. The most important numbers are the income thresholds, $75,000 for single filers and $150,000 for married couples. You have to stay under that to get the full benefit. This means you need a firm handle on your modified adjusted gross income, or MAGI. That includes IRA withdrawals, 401k withdrawals, and a portion of your Social Security. This is a powerful tool that just became even more valuable. Second, if you're close to a threshold, start planning your income now. You want to be proactive. You might be able to delay certain retirement withdrawals or plan your capital gains to stay under the limit. If you have required minimum distributions, RMDs, look at doing a qualified charitable distribution, a QCD. That lets you send money from your IRA to a charity which satisfies your RMD but doesn't count as income. This is a powerful tool that just became even more valuable. Third, don't confuse this with other promises. You may have heard talk about getting rid of taxes on Social Security entirely. This bill does not do that. It's a deduction that reduces your taxable income, which helps lower the tax on Social Security for many, but it is not a total elimination. And finally, and this is the most important advice, consult with a professional. The rules are complex, and the final version isn't even law yet. A qualified tax advisor or financial planner can look at your specific situation and build a strategy. This is what we do all day at my law firm, KKOS Lawyers, helping clients navigate these changes. So what's the bottom line? This new $6,000 senior tax break could be a significant, though temporary tax break for millions of middle-income seniors. It stacks on top of your existing deductions and can seriously lower your taxable income. But it's not a silver bullet. It does little for the lowest income seniors and phases out completely for high earners. And remember, the final version could end up being the House's $4,000 figure instead of the Senate's $6,000. The situation is still developing. This is exactly the type of financial news we track here. To stay updated on this bill and get more strategies for protecting your wealth in retirement, make sure you subscribe to the channel and click the notification bell. The laws are always changing, but with the right info, you can be prepared. Again, this is The Wealthy Elder. We'll see you next time. Let's build wealth.